Hey guys, this is Nick Brown and Brian Cayley. We're going to do a quick live here with you guys today on the home buying process and some things you need to know. We're going to cover a lot of stuff. Brian's going to talk about the buyer consult, looking at homes, making a wish list, offers and negotiating, the appraisal and loan finalization, and really a tool that he's offering people for free right now that really helps with all of this. And then today I'm going to cover first steps, the timeline, what you need to know about the loan types, down payment assistance, some pricing tools to figure out what you can afford, and what the next steps are if you're interested in doing that. So without further ado, I'm going to pass it over to Brian, and he's going to talk about the buyer consult. Brian.
All right. Hey, thanks for joining and watching our video. One of the first steps is sitting down, and it can take anywhere from 30 minutes to a couple hours, but trying to figure out exactly what you're looking for, where you want to live, what style of house or property, or whether it's a townhome, condo, house, area of town, etc. And then just figuring, and not just what type, like 3-bedroom, 2-bath, basics. No, trying to figure out, like I usually will sit there and say, okay, describe your property. Describe what do you visualize? Are you looking at hardwood floors throughout the main level? Do you have updated kitchens with certain color cabinets and countertops, etc.? So we look into all of those things that are important to you, and then just really coming up with a wish list that we can use kind of as a roadmap to find that perfect house for you. And then once we once we figure that out, then the next step will be we'll get into looking at homes and all that. One of the best things that you're going to find out is, and one of the questions that a lot of first-time home buyers or new buyers have, is how do the agents get paid? Who pays my buyer's agent? And the good news with that is I would work exclusively for you, but the seller actually covers the commission for the buyer and the seller's agent. I can go into a lot of detail on how that works, but the good thing about that is I work exclusively for the buyers, negotiate for them in their best interests, everything that's involved with the process. And then from there, the seller covers all that commission, so you don't have to worry about that, which is nice. So I'll turn it back over to Nick so he can talk about the timeline, first steps, and getting qualified with the loan.
All right, guys. Thanks, Brian. And just to dovetail off of the back of what Brian's saying about the seller paying for both agents in Colorado, it really does make sense for you to have your own agent. Some people say, hey, why don't I go to and just use the seller's agent instead of having my own? That's probably the worst idea of all time. Two things happen when you do that. One, that agent is working for the seller to get them the most for the property. So to use them for both you and the seller is a conflict of interest for you, because they're trying to get their client, who's the seller, the most money. So that would be a horrible idea. The second reason that's such a bad idea is because then the seller, since you're not bringing in an agent that they were going to pay for, the seller just pockets that money. So it's not like they're passing a deal on to you either. They're going to jack up the price and keep more money. So at the end of the day, definitely find an agent. Agents are not all created equal by any stretch. Definitely, obviously, I recommend Brian. That's why we do these together, because he's just an excellent negotiator. He really understands value in the marketplace, but we can go into that later. Really, what I want to talk to you about right now is the timeline and the first steps for home buying on the loan side. So I see two main questions. I always see, hey, Nick, we're not ready to buy yet. And also, what will happen if you pull our credit right now? We don't want a credit ding. So let's start with the first question. Hey, Nick, we're not ready. If we do this now, is this going to expire? Or, we don't want to start the loan process because, we're 6 months out, or we're going to buy in the spring, or we're a year out. And so my question to that, or my answer to that, is always more information sooner is better. So the sooner you can get the pre-approval for a home loan, the better off. And the reason that is because we have an opportunity to uncover any issues today. And so that when you're actually ready to buy, maybe 6 months from now, it keeps you from having a situation where you might be saying, oh, let's pull the trigger, let's do the loan stuff. And then we find out you've got this perfect home that you want to get under contract with, and you can't afford it because there was something we could have caught 6 months ago and fixed, but now we didn't know that. So now you miss out on that perfect home because you weren't ready. I also see this happen a absolute ton where someone will tell me, oh, Nick, we're not buying in the next month or two. We're going to be 6 months out. And this happens probably 80% of the time when somebody tells me they're 6 months out. 2 months later, they're like, we found the perfect home and we're ready now. We're ready. And the last thing we want in that situation is for you to not be ready on our side, and for you to miss out on the house that's perfect for you. We don't want that buyer's remorse. So that's super important. Also, will your pre-approval expire? Short answer to that is no. Basically, as long as your income and your down payment and your credit score and credit profile stay the same, that pre-approval is good until any one of those things changes. Now, your credit might expire, or we might need an updated pay stub. All of that is super easy, but once we refresh that, you're back to fully approved and ready to rock and roll. So that's super important. The other big question people have is, Nick, well, you're going to pull my credit. That's going to drop my credit score, right? Not necessarily. In fact, probably I would say 95% chance, no, it won't drop your credit score. What really drops your credit score when you're getting it pulled is when you're getting a bunch of credit card pulls. Now, why would that drop your credit score when you're trying to open up credit cards? Well, the algorithms, the 3 credit bureaus know that, hey, they're trying to open up 50 grand in credit card debt. That means they're probably going to use 50 grand in credit card debt. That's not going to be good. Like, that's a red flag, right? Why is that? Did they lose their job or whatever? So why does that ding their credit score? Because, it's a signal of, hey, they might be in financial distress. We're going to lower their credit score temporarily because of that. Now, we pull under what's called a mortgage pull or a mortgage score. So that's really nice. It does not ding your credit score like a credit card pull does. So never fear, don't worry. That is not a factor. The most I've ever seen somebody's score drop with a credit pull from us is 2 points. So when you're talking about a credit model that scores at 800 points and above, 2 points isn't going to make a difference, but most of the time it doesn't change their score one bit. Also, it is super important because the credit we pull for the mortgages uses a slightly different algorithm than Credit Karma and MyFICO. They're using a consumer report, which is often inflated, and you really don't want to be going under that because you might find out your credit you thought you had needed some work or help, and we can do that now instead of later. Now I'm going to pass it back over to Brian. He's going to talk about looking at homes and how that works online and in person. Brian.
All right. So once we determine the type of home, the price, all that, then I set you up on a search tool that we punch in all of those, your wish list basically. And then you start looking at property online, look at photos and videos and all the details of the property itself. And then once you kind of start getting a feel for what's out there in your price point, and like, wow, I like these, I like this neighborhood, start driving by some of those neighborhoods, because that can make that's huge on where you want to live. The schools, the parks, the trails, retail, all those things come into play. And then once you kind of figure out, okay, let's kind of narrow down to these couple of neighborhoods or this area of town, then we actually will set up the showings and get out there and actually, physically walk through them. And then once you're into that realm of, oh wow, let's go look at this one, and this one's a hot property and it's in great shape, there will be times where we'll look at something that night or the next day, it could go under contract. So I always try to, hey, let's build a list of 1 through 5 or 1 through 3 or 4 or whatever. That way it's like, okay, this property comes up. If it goes under contract, not a big deal. Let's just go to number 2 and keep going that way. The way the market usually works, Thursday, Friday, and Saturday, majority of the properties come on the market. And the way the market is going right now, depending on the price point, we're seeing a lot of multiple offers. And especially in that 300 to 500 range, there's anywhere from 2 to 3 up to even 9 or 10 offers, especially if the property's in really good shape. So there's a number of things you can do to get that. Probably one of the first things is getting pre-qualified, like with Nick,
sure.
and having that pre-qual letter in hand ready to go up front, because when you do like that house and you worry about, man, I don't want to lose our chance. And if you have to go to the process, get qualified after you find that house, 2 or 3 days go by and that could easily go into contract with somebody else. Mm-hmm. So being proactive is very important. So those are really the steps. Once we, find the property, find everything you're looking for, and we just narrow it down. If it's not out there, then you can wait a week or a month, or set you up on a search where anything new that comes up today or tomorrow, you'll get notified, and then we just look at it right away. And the typical process, once we find a house, timeline, would you say probably 30 to 40 days from the offer to closing, is right around a month, give or take a handful of days after that. So, okay, I'll turn it back over to Nick on the loan types, because there's a lot of different options.
Great. So thanks, Brian. So loan types. So there are actually 3 main loan types we're going to run into here, and none are really bad options. It's just I look at it as good, better, best. And so kind of keep that in mind as we go through these. You're not stuck with these options forever. We can always refinance down the road and get you into a better bucket later. But the key here is we are going to try and get you in one of those buckets that fits you the best and that can allow you to buy a home the soonest. What we find is that people that buy sooner build equity faster and eventually have more equity. And so I always say, when is the right time to buy? And I know this sounds biased, but it's sooner than later, because that just gives you more time to build that equity over time. Now is such a great time to buy too, because interest rates are just so low. Your payment will be so much lower than if you were to wait 6 months from now and rates go up 1% or something like that. But let's get into those loan types right now. So the first loan type is the very best, top of the heap, is if you have conventional financing, which requires a conventional with 20% down payment. Now, 20% down payment, that's a pretty big hurdle to clear, especially here in Colorado. That could be $100,000 for a home you're looking at. Not everybody has that, don't worry. But I do want to go over the benefits of this program. So usually you need pretty good credit for this, and then you need obviously 20% down payment. And the benefits of doing it this way is that you get the very lowest interest rate. Interest rate is just a clever way of saying bank profit. And so you pay the very least to the bank in this unique scenario where you have a bunch of money. The other benefit is you get to avoid something called mortgage insurance, or you might hear it as PMI or MI or private mortgage insurance. And what this is, it's not insurance for you, it's insurance against you that the bank takes out against you. But guess who gets to pay it? You do. So if you can avoid mortgage insurance, you'd probably want to, but it requires 20% of your own money, your own skin in the game, in the form of down payment. So not everybody has that. And so no big deal. We go into tier number 2, which is anywhere between 3 and 20% down payment, and with a good credit score. So this would be conventional financing. Conventional just means we're selling to Fannie Mae or Freddie Mac, and they usually like to see at least a good credit score for this. Now, what are the pros of this bucket? The pros of this bucket are that mortgage insurance that you're going to pay is more affordable than if we fall into our last bucket, FHA, which we'll talk about in a minute. But also, you still get pretty good deals, pretty good interest rates, and the other big thing about it is that the mortgage insurance will eventually fall off and go away, unlike the final bucket we're going to talk about with. Now, one of the downsides is that the more help you need with down payment, as in the less money you bring in, the more expensive that monthly mortgage insurance is. So that's a downside. Now, the final bucket is kind of a catch-all, and it's called FHA, as we mentioned before. And it actually has a lot of really nice benefits. But first, what kind of fits into this bucket? Well, if you don't have a lot of down payment or you need down payment assistance, and if your credit score is in the 600s instead of the 700s for the other two buckets, FHA is going to be an option for you that's going to make a lot of sense. And I would say, don't worry, about 40 to 50% of first-time homebuyers start in this bucket. So don't feel bad about that. It's just a tool to get you in there. So Nick, what's so bad about FHA? Well, first off, not a whole lot, because the interest rates can often be better than in the other two buckets. That's amazing. And you only need 3.5% down payment to fit in this bucket. So why doesn't everybody use this, Nick? Great question. Thank you for asking. The reason is because it has two types of that nasty mortgage insurance. One, that they charge you monthly, which is almost double than if you were in the one up higher bucket. And also, they charge a second mortgage insurance that they tack on to the end of your loan of 1.75% of the loan size. So for every $100,000 in loans you borrow, they tack on $1,750 that you need to pay back. Goody. So you're automatically going in the wrong direction in your equity with an FHA, but it's not the worst thing, because if it gets you in a home, you're going to get that 1.75% of equity back in the first year if you're buying here in the Denver area. So that makes a ton of sense. No big deal. The other downside to the mortgage insurance with FHA is that even if you eventually pay the loan down to where you have 20% equity, like the buckets above, that mortgage insurance never drops off. You have to do what's called refinancing into one of the higher buckets to get rid of it. No big deal, though. The fourth thing I do want to talk about is down payment assistance, and I'm actually going to talk about that here in a minute as its separate thing. Right now, I'm going to pass it back over to Brian. He's going to tell you a little bit about what making offers and negotiating looks like in this market today.
Okay, so once we find your dream home or the house that you're like, wow, I could see us living there, how do you know what the right offer is? Okay, well, I'm glad you asked. The first thing is we evaluate the property condition, everything else, and then we look at 3 solds in the neighborhood and then 3 active properties that are currently in the neighborhood. And we try to stay within that specific neighborhood. If we can stay within a mile or even closer, half a mile, that's what we want to do based on square footage, bedrooms, baths, all those different things. And then we can adjust the value a little bit depending on upgrades, or if it needs certain things, we can go plus or minus. And then once we find the value of the property, we usually try to come up with a decent range. And it needs to be within your qualification from the loan standard to make sure that you can actually afford it and everything else, so that we're not. And we don't necessarily, if you're qualified up to a certain number, let's say you're qualified up to 400, and we find the house it's worth 410, we don't want to write it above that, because one thing that's very challenging right now in this market is you need to kind of give yourself a little bit of a cushion in case you need to offer a little bit more than the list price, because there are multiple offers on a lot of good properties. And not in every case, but a lot of cases there is. So let's give an example. Like if there's a house listed at 350, but let's say the comps justify and the market analysis is like, wow, this is worth 360, maybe 370. Then we can go in with a strong offer. I usually ask a lot of different questions from the listing agent to determine. One of my first questions is, do you have any current offers? And then second, if they say yes, then I try to find out some more information on that. And then other than that, I ask the seller, hey, what's important to the seller other than price. And they'll usually give you an idea of, hey, is timing important? Is, we got to close really fast. Or, hey, we need 2 weeks extra after the closing so that we can close on our next house, and then time to move, et cetera, and all that. So all of those things, the dates and deadlines and the price, all of that kind of works with itself. And it's not always the price that's going to get the house. You could actually be a little bit lower, but if you're going to work with the seller on moving time and be flexible on all of that, and you're 5,000 less than the next highest bid, then there's a lot of times you can end up with the house and get your offer accepted because you're willing to work with them. And if you can make that connection, that's usually a big deal with the seller. And Nick has a pretty good story about that. So those are definitely things that, and there's a lot of different tactics and techniques that we can do in the contract, which that could be another video all in itself, just to give yourself the advantage. But I would say one of the top advantages is having the right lender letter and the lender itself. Just getting, it's like Rocket Mortgage. Let's use them. If you just get a pre-approval online from Rocket Mortgage and now you try to go buy a house here, yes, good luck. First of all, they're not local. Timing is going to be a nightmare. Getting it through underwriting down the road, there's so many different things that.
Well, and the seller's agent understands this as well. So
yes,
they really want to see a local lender, all in-house lender. So
yeah, one of the first things that a listing agent, because when you submit the offer, the contract, then you submit the lender letter with that, they're going to call up the lender and say, hey, are they pre-qualified? Have you ran everything to make sure that they're good to go? And when they're ready to go, then he's going to, hey, have I heard of this company? He's going to want to know that it's a strong lender that's been around a while, that has a good stability, and they can close the loan. So all of that comes into play. And you don't want to hit, one of the other questions is that I think you'll touch on too is, do I need an agent to write an offer to go after a property, and should I just call the listing agent? Well, short answer, no. It's not in your best interest. But I'll let Nick even touch on that too. So there's a lot that goes into that, and I'll stop rambling a little bit. But I'll turn it back over to Nick. He can talk about the down payment assistance and touch on a couple of those subjects that we just talked about.
Awesome. Yep. So kind of dovetailing off of what he was talking about, the seller in Colorado pays for both of the real estate agents. So this is super important. The question he was alluding to was, should I don't have an agent, should I just go talk to the seller's real estate agent? And you definitely should not, because that real estate agent is working to get the seller the highest price they can. So they have the seller's interest in mind, not your interest in mind. Also, well, but Nick, what if I'm using them? Am I more likely to get the offer accepted? No. What's going to happen, or can I get a better deal? The answer is basically no. The seller gets to pocket that money. And so there's absolutely no reason to not get your own agent who is fiduciarily responsible to you instead of the seller. Oftentimes, I have seen a few times when people have tried to use the listing agent as their agent, and it's just they're getting a horrible deal. They're losing a ton of money. The seller is getting a great deal, and it just doesn't make any sense at all. The seller's pocketing that money, and you're going to get a worse deal. So you should 100% use your own agent because that agent can tell you if that property is over or undervalued. You don't really know unless you've got a really good agent explaining to you, hey, this house only comps out at 400,000. The list price is 410, and the seller's agent wants you to go 415 to win the offer. Well, you just gave them $15,000 over what you should have. And then the seller also keeps another 15 grand for the real estate fee. So it doesn't make any sense for you. The seller would probably love you for that, or the seller's agent, but you're going to overpay you're probably going to have appraisal issues because if there is a gap in what the appraised value comes back at and what you are listing, you have to cover that if you want to buy that home. So let's say it comes in 15 grand low. You've got to bring an extra 15 grand now that you weren't planning on doing just to get that home. And it's just a horrible idea. We can do that without the need for, we can do that without having another agent doing that for us. So, all right, let's talk about down payment assistance programs. So down payment assistance programs are that basically there are pros and cons to using them. The pro is that they're going to help you with the down payment assistance, that extra maybe 3 or 3.5%, so that you don't have to bring in a ton of money. And sometimes in some situations, you can bring in no money at all, which is really nice if you're kind of strapped for cash, but you can qualify for the house payment. So why would you use one and why would you not? So here's the truth. No one is altruistically really nice and just giving you money for no good reason because they like you, even though they've never met you. The truth is they are doing it because it makes them more money. So how do they do this? It's basically a shell game. What they're doing is they're taking and jacking up your monthly payment, and what they're going to do is going to get paid more over time. And so they're willing to give you a chunk of that money that they're going to make over the next 3 years in higher payments as down payment assistance. It's really not assisting you in the down payment. They're not giving you any money. They're giving you money up front and you're paying them way more back over time. So you get a way worse deal typically in your monthly payment. Also, that means you can afford less house because more is going towards the house payment than would be if you could, more is going towards your payment than if you were able to bring in at least 3 or 3.5% on your own. So that's super key. I always say the magic number is if you can get to 3% of your own money, you don't need a down payment assistance program. We can use that conventional financing with 3% down if your credit's good, or if your credit's not great, we can look at the regular FHA, which only requires 3.5%. So if you can hurdle that 3% of your own money at closing, say it's a $200,000 home, you would need what, $6,000, $300,000, or $300,000 home, you would need about 9 grand saved. And if you can do that, then you're going to get a much lower monthly payment for that house. That's basically how they work. Now, Denver has probably 15 different programs that I'm aware of. My company signs up for all of them. And the truth is, some are going to be better than others for your unique scenario. So just know, if you want to get more information on which one fits for you, you really need to talk to a pro because you're not going to be able to figure it out. My assistant has been working for me for a year and she still has questions on this because I've been working with these for decades now. I've been in the industry for 16 years, and you really got to understand all the ins and outs of them. So I would highly suggest don't try and go it alone. So many people are looking at CHAFA programs and they fit so much better into the Metro DPA with, a different type. Each of these has like dozens of programs underneath. So you really need to talk to a pro. I would highly suggest at least. Also, we're going to talk about a tool that's going to help you with that on my next little chat. But I'm going to throw it back to Brian. He's going to talk about, what are you going to talk about? I'm
going to talk about the next steps after we get a property.
Great.
So once we get a property under contract, once you have that winning bid, and now you're really super excited. Now the stress is going to be there a little bit for sure. But the next step is to have an inspection done on the property. And one of the main things you look for, in the first 10 days of the contract or sooner, you schedule an inspector to go out, and it's a totally a third party. He doesn't have a skin in the game or anything. He or she is going to go in, look at the property from top to bottom. They try to look at all the health and safety items, whether it's the roof, the furnace, sewer line, could be just really a lot of the big dollar kind of things. You're not really looking for the small stuff. If it's a loose handle on a cabinet, we're not too concerned with that kind of stuff, but we're looking for the big dollar stuff. So once the report comes back from the inspector, you kind of go through all those things. And everybody's a little bit different on what they can handle and not handle. I've had people in the past that say, yeah, I don't mind doing some work. And then when it comes down to it, a lot of the items, they don't want to fix anything, or they don't want to even paint or, do that. Well, that actually can change the type of house you're looking for, because then you got to look for nicely updated kind of house, this and that. But if you're handy at all, and you can do some stuff on your own, that's great, because then that can give you an example, or advantage, I should say. And so it's like another layer of negotiation a little bit, depending on what comes up. And we try to get the sellers to, fix different things, or give a credit, or give an assistance towards those items that are important to you as the buyer. So now, once you get through the inspection, and then everything's moving forward, the next step is to have the appraisal ordered. And once that is ordered, you're looking at probably another week and a half by the time that gets ordered and back to the lender. The lender actually orders it, and then we'll get the value, get the actual appraisal report. Now, depending on the offer that we wrote, at or above the list price, we know that the appraisal is going to come in right around our number, as long as we did a decent job of finding out the value, had good confirmed comps in the neighborhood that can justify the price that we wrote. And many times, a lot of times I'll see properties that I wrote for the comps to justify our offer price. Most of the time, one or two of those for sure will be on the appraisal report. And if they're not on there, there's either a lot of comps that you can use, or I didn't do my job very well. So it's, but it's an important piece though, because if you're really sitting there sweating like, oh my God, I don't know if this is appraised, you really should have a pretty good idea of where it's going to come in, at least within a few $1,000s. So, but that's another level of, and the appraisals, believe it or not, the buyer pays for the appraisal, but the appraisal is more for the lender than it is for the buyer. Most appraisals, especially on a first-time home purchase, well, any purchase really, they don't, in most cases, appraise much higher than the actual contract price.
Right.
So the appraiser is going to go out there, they'll have a copy of the contract, and really what they're looking for, okay, I need to justify this, because the bank's not going to loan the money if the property value isn't there. So They want to know that they're protecting their asset, and the buyer wants to know, hey, yeah, I want to make sure I'm not overpaying.
Right, getting a fair shake. Yeah.
Right. So most of the time, and I've had buyers like, wow, it only appraised for like $3,000 more than the contract price. I'm like, yep, that's perfect. Right. That's usually 98% of the time that happens. Now, if you get a smoking deal, and I've had it happen in the past where you're 15,000 under where it should appraise, sometimes it'll appraise that much higher.
Sure.
You can't control that. And as agents and even the lender, we don't have any influence or control over the appraiser. That's a third-party independent deal with the transaction. A lot of that stems from back in the Great Recession, 12 years ago.
Yeah.
But once the appraisal comes back and you're comfortable, everybody's like, oh, great, it appraised the value, we're good. Then really the next step is you're finalizing the lending piece of it, getting the lender all the documents they need to finalize the loan, and then they put everything through underwriting, kind of finish that piece, and then you get excited because then you wait usually a couple weeks, week and a half or whatever, to get ready for closing itself. And
that's right.
Back to Nick.
All right. So a couple of things. Yeah, he's exactly right. The appraiser is typically not going to come in at a higher price, appraised value, unless there is a ton of equity there. The reason is they just don't want, they understand it's probably not good to throw up a red flag if like you're getting a $50,000 break on a home. So typically it almost always comes in right at that purchase price. Like Brian alluded to, the appraiser has the contract in their hand. And at the end of the day, a home, a lot of people, there's a couple schools of thought. A lot of people think that the value of a home is what someone is willing to pay for it. But that's not always necessarily true, because if you're trying to inflate, if the seller's trying to inflate the value, really the value is more akin to what other people have paid to similar homes around it recently. And so that's kind of how the appraisal process works. Don't expect the value to come in much higher or really any different from the purchase price. Like he said, if the seller's agent and the buyer's agent are doing their job, then then all three of them should have come to a very similar commensurate. I can't think of the word. You know what the word I'm thinking of? No. It starts with a C. But yeah, they should all have a consensus. That's the word, consensus on that's all pretty similar on the value of that home. So the next thing I want to kind of give you guys a little bit of info on is I've got a pricing tool that's going to help you determine what your monthly payment would be for a bunch of different loan types, whether that's 3% down or the FHA I talked about, even some of the down payment assistance programs. So you can see, based on what the value or the price of the home you'd be paying, what your payment would be for each of these, and also how much you'd need at closing would be, down payment, closing costs, all that fun stuff. So if you want that tool, feel free to reach out to me. The benefit of this tool is it's specific to Colorado and the Denver metro area. I know a lot of people go online and they look at home buying tools, and they come to me and they're like, well, this tool says I can afford XYZ, or my payment was going to be ABC. Why is it so different? Well, I say, well, that's a national tool written by some programmer who doesn't know anything about homes. He's just typing code, right? So the benefit you get from me is that my background is in programming, and so I made my own, which is way more accurate because I also understand not just how to put a tool together, but also to actually customize it to your unique scenario here in Colorado and the Denver metro area. I'm going to pass it over to Brian. He's going to talk about one of the tools he offers.
Yeah, one of the tools that I offer is a search tool. It's called Real Scout. And the benefit with using that over some of the other tools that are out there, and I'll just name drop a couple of them, like Zillow and Redfin. They have great photos and a lot of different things, but one of the negative things that I've found from past clients is that they're not updated like on a regular basis, like daily. You'll see properties that have closed prior, like a couple weeks, even a month before, and people are requesting to see them. So Real Scout, actually, everything that you're looking at is updated daily, directly linked to the MLS. And so if it's showing up there, it's active. It's currently available to go out and look at. And now when it will show that it's under contract once it changes status, basically. And if it's closed, it won't even be on there. So the nice thing is also that you don't get bombarded with outside ads and a bunch of just crazy stuff to distract you and do all that. But you can really dial in exactly what you're looking for. You can go off that wish list that we talked about early, and you can dial in everything, and you can play around. You can look at the map of the metro area. You can pinpoint different neighborhoods. You can draw in exactly where you want to be. If there's a school district, hey, I love this school, you can draw right around that. You can hit that exactly. And the nice thing also, when you're looking at that, you can favorite different properties. I'll get notified of, hey, yeah, they like these three properties. You can message me in there, hey, I'd like to go see these. Hey, let's set it up and get you in, that kind of thing. So that's, and just message me on that and just type in search tool, and I can shoot that over to you. And yeah, it's a great tool that I've had a lot of success with it, and great. And we can message right in between. It's pretty nice. So, all right.
Well, I'm going to talk a little bit about kind of what you should do today. What really, at the end of the day, you're watching this because you're looking for clarity in the process, and so that's why we're offering these two tools. By the way, completely free. We're not gonna bug you. We're just gonna give you the tools. We're gonna let you do your thing, and at the end of the day, we want to get you the info. And if down the road you want to use Brian or I to get the loan or as an agent, we're more than happy, obviously, to do that, but super low pressure. We just want to give you the information so that you have clarity going into the process. So number one thing to get clarity, I find, is that people need to really get their roadmap dialed in for the approval process to figure out what home price and down payment options you're going to go with. The worst thing in the world, I think I might have mentioned this earlier, but now that we're 40 minutes in, I can't recall what I've already told you. But the worst thing in the world is to fall in love with a home and then find out you can't afford it, or you, even worse, could afford it, but you just had to make a couple of changes in your scenario, but by the time those are done, the house has been snatched up by someone else. Mm-hmm. And so the number one goal for me is to get you that clarity, and it's really easy. The first step for you to do that and to get clarity is to just fill out a loan application. You're like, oh God, he wants the loan app. Well, here's the good news. It doesn't lock you into anything. If something changes, no big deal. It's a living document. So, but the real benefit is that it's all information, your date of birth, where you work, how much you make, and all these things, what type of pay you receive, what kind of money you have for down payment, if you need down payment assistance, what your credit score is. But the real benefit is we get to see the whole picture, especially your credit. Like we said, checking credit is incredibly important early on, because if you do find that home and we didn't pull credit, and then we find out we could have easily fixed something or paid off a card or got done a small tweak, you're going to be kicking yourself that you didn't do that sooner. And we really want to avoid that situation. So that's kind of the first step. Take a quick loan app. Take you 5 minutes. And if you like that information, feel free to reach out to me. I can get you a link to that. It's online and very easy. But the benefit to that is then once you do that, I create a customized plan for your unique scenario so that you have complete clarity of what you can afford per month, how much money you'd need for what down payment, and what price range that drops you in, so that when you're checking out his Real Scout tool and you're looking at a home, you can pull up my tool and say, okay, I put this price in, my payment's going to be exactly this, and I'm going to need this much money to use this particular program, or this one I don't need, but my payment will be this. Super easy. Number one thing we want to get you is clarity. So guys, I think that's pretty much it. Brian,
can I add to that?
Yeah, go ahead.
One thing on that also, when you have your money that you're qualified for, let's say you're at 300. And depending on the type of property you're looking at, if there's, I just want to throw in there, if there's an HOA. So if you're looking at a townhome or a condo and you're like, oh, I can afford this house. Well, if there's an HOA of, let's say, $150 to $200 a month, that might be an adjustment that's needed to be made because you might only qualify for $380 at that point, because the lender on your monthly payment, your estimate on the calculator,
right,
you add that amount from the HOA onto that.
Exactly. And this tool that I'm providing factors that HOA in, so you're not accidentally using really bad numbers. That the HOA on a condo really drops your purchasing power because it eats up so much extra money, often $200 to $300 more per month for the same priced house as another one. So you might think there might be one home that's a condo for $300,000 that you can't afford, but a single family $300,000 home you can, because it doesn't have that extra money dumped into the HOA. Right. So definitely you want to have a good tool, and the online tools, unfortunately, are just lacking.
Yep. So really, other than that, once you're, we got the house and everything else, you get ready for closing. Closing is actually pretty simple and can be fun. It's 45 minutes of just signing paperwork
till your wrist hurts.
Yep, pretty much. And then you get the keys and you schedule your moving, rent your truck and find your true friends and feed them and whatever you need to do that day to get the moving process going. So, and then you enjoy your home.
That's right.
After that, then you just, any questions about anything, you ask, either or, anything comes up, because there's a lot of times there are things that comes up. So, and yeah, I think that's about it.
That's it. Well, thank you guys so much for joining us today. I hope it was helpful. Again, if you have any questions, we'll put our contact info here. But other than that, have a great rest of your day. We'll see you later.
Thank you.
I never know how to turn it off. Yes, I do.